The imminent launch of a spot Bitcoin exchange-traded fund, ETF, by BlackRock has sent ripples of anticipation throughout the cryptocurrency industry. This development is poised to facilitate unprecedented institutional entry into the realm of cryptocurrencies, signifying a noteworthy departure from established banking institutions and holding the promise of substantial capital inflows. These developments hold the potential to usher in a new market cycle, reshaping the industry. Nonetheless, the present state of the market is still characterized by speculation, primarily driven by prominent investors, some traditional firms, and individuals deeply embedded in the crypto space. It's essential to recognize that we are dealing with derivatives rather than ETFs at the moment. Price discovery for Bitcoin, BTC, largely hinges on derivatives such as perpetual contracts. These leveraged orders can be liquidated under specific conditions, whether during an upward surge or a pullback when traders take profits or leveraged positions are liquidated. As such, the recent price increases following the ETF announcements may not be solely attributed to a fresh influx of institutional capital. Instead, these fluctuations are more a result of speculation surrounding ETFs, mainly driven by those already well-versed in the crypto market, including major investors. Nonetheless, this heightened interest from institutional players remains a significant development. It's possible that the capital sustaining BTC's outperformance against traditional assets may have come from substantial institutions or shrewd capital allocators positioning themselves ahead of positive ETF news. The dominance of CME futures in the crypto futures markets suggests the involvement of more traditional institutions in this speculation. The eventual flow of capital from BTC ETFs into the market is a prospect worth monitoring. According to former BlackRock Managing Director Stephen Schoenfield, an ETF approval could potentially inject $200 billion into Bitcoin. Additionally, AllianceBernstein, a global asset management company, foresees an increase in crypto asset management following BlackRock's ETF approval. An ETF's approval signifies a substantial surge in capital accessibility to BTC. However, this inflow of capital will take time as investors and asset managers digest the news and decide to allocate their resources. Furthermore, the adoption of this financial product will require years as various institutions, including broker-dealers, banks, and registered investment advisors, navigate through due diligence processes before offering BTC ETFs. The involvement of key players, particularly market makers, is crucial in building investor confidence. Market makers are responsible for creating and redeeming new ETF shares, ensuring the ETF's price corresponds with the implied value of its holdings. In terms of broader market impact, the effects of a BTC ETF on the entire cryptocurrency market, beyond BTC itself, remain an intriguing question. Historical market cycles have typically begun with BTC, followed by Ethereum, ETH, and then extended to smaller altcoins and more innovative projects. While the effects might be less direct this time, they will likely be noticeable. It's important to note that a rising tide effect is not guaranteed once ETFs go live because the influx of capital won't directly translate to the ownership of BTC. Investors choosing this instrument won't easily diversify their exposure to other cryptocurrencies until more ETFs become available. However, as more money flows into an ETF, a larger portion of the underlying Bitcoin must be purchased. This in turn leads to price increases that benefit portfolios holding BTC directly, providing them with more capital for diversification into other cryptocurrencies.